Hey Iguana investors, welcome back to the Daily Digest where we cut through the noise. It's Iggy, your guide in the often confusing world of the Singapore stock market. With over 1 million watch hours on our channel and a global view on economics, my job is to help you see what really matters. Today's theme is simple. Look under the hood. We saw a mixed bag on the market this morning, and it's easy to get swayed by scary-looking numbers. But as we'll see, the headline figures often don't tell the full story. Let's dive in. The Singapore market had a soft start today, 29 October 2025. The Straits Times Index, STY, dipped slightly by 0.13%. It was a day of tug of war. We saw some strong individual performers like China Aviation, which soared 6%, while big names like CapitaLand Invest and Mapletree Pan-Asia REIT felt some pressure, both down over 1%. This kind of split market shows that investors are being selective. They aren't buying or selling everything at once. Instead, they are looking at each company's specific story. And that's exactly what we're going to do. Mapletree Logistics Trust reported a lower distribution per unit, DPU, of $0.01815 for its second quarter. That's down from $0.02027 a year ago. Revenue also fell by 3.2%. The main culprit? Weaker foreign currencies against the strong Singapore dollar. Despite this, the unit price actually climbed 2.3% yesterday. Iggy's take. This is a classic case of not judging a book by its cover. The lower DPU looks bad, but it was mostly caused by currency exchange rates, not failing properties. MLT has assets all over Asia, and when their earnings in Japanese yen or Malaysian Ringgit are converted back to our mighty Sing dollar, they look smaller. The fact that the market pushed the price up tells you that savvy investors saw through this. They know the underlying logistics properties are still solid. The lesson here is to always ask why the DPU fell. If it's a forex issue and not a tenant issue, the problem is often temporary. Keppel REIT's distributable income for the first 9 months dipped a tiny 0.6%. But here's the important part. Its net property income, NPI, grew by a very healthy 8.6% to $161.3 million. The market liked this, sending its unit price up 3.9%. Iggy's take. Don't let the small dip in distributable income distract you. The real story is that strong NPI growth. NPI is the core profit from a REIT's properties, rent minus expenses. When it goes up, it means the buildings themselves are making more money. This shows that Keppel's office properties are in demand and performing well. A strong NPI is one of the best signs of a healthy REIT. What's next for the REIT sector? Let's look at another one. CapitaLand Ascott Trust, which owns serviced residences and hotels, reported a 1% rise in gross profit for its third quarter. This was thanks to better performance and upgrades to its properties. On a same-store basis, profit was 2% lower, but this was due to a one-off tax adjustment in Australia. Iggy's take. Ignore the one-off tax item. The key metric to watch for a hospitality trust is revenue per available unit, RevPAU, which grew 3%. Occupancy also rose from 79% to 83%. This tells you one thing loud and clear. People are traveling and staying at their properties. The recovery in global travel is directly boosting their bottom line. This is the fundamental trend that matters for class, and it's pointing in the right direction. ESR REIT had a fantastic 9 months. Its net property income jumped 28.6%, and distributable income rose 6.8%. This huge growth was mainly fueled by the purchase of new properties. Iggy's take, ESR REIT is in growth mode. It's using acquisitions to boost its size and income, and it's working. When a REIT buys new buildings, its revenue and NPI naturally go up. For investors, the question is always, did they buy good assets at a fair price? For now, the numbers look great. The next step is to watch if they can manage these new properties efficiently and keep tenants happy. This is an aggressive strategy, but it's delivering results. Property developer Hur is raising $175 million by issuing new notes that will pay 4.8% interest per year. The company will use this money for general purposes, including new investments and refinancing. Iggy's take. When a company issues notes or bonds, it's basically taking out a loan from investors. The 4.8% interest rate is the cost of money for Hur. This number is a useful benchmark for us. For we Hur to create value for shareholders, any new project it funds with this money must generate a return higher than 4.8%. It sets a clear hurdle for management. Keep an eye on what they buy or build next and see if it looks like it can beat that 4.8% bar. First REIT, which owns hospitals in Indonesia, saw its distributable income for the 9 months fall 6.1%. Its DPU also dropped 7.3%. The main reasons were the weak Indonesian rupiah and a larger number of units in circulation. Iggy's take. This is another example of currency risk hitting a Singapore REIT hard. Like MLT, First REIT's underlying assets, hospitals are likely doing fine, but when the income is converted from rupiah back to Sing dollars, it shrinks. This REIT is a pure play bet on Indonesian healthcare, which comes with emerging market currency risk. It highlights the trade-off investors have to make. Are the higher potential returns from an emerging market worth the currency volatility? Finally, LHN Group's co-living business Caliwoo is launching its own IPO to list on the SGX mainboard. LHN is spinning off this fast-growing business into a separate company. Iggy's take. This is a classic move to unlock value. LHN has several different businesses, and its successful Caliwoo brand was perhaps not getting the full valuation it deserved while tucked inside the parent company. By listing Caliwoo on its own, the market can price it as a pure-play co-living operator. This could be great for existing LHN shareholders, as the value of the shares may re-rate higher. For new investors, the Caliwoo IPO is a chance to invest directly in the growing co-living trends. So what's the big takeaway today? It's clear that you can't just react to headline DPU numbers. We saw two REITs, MLT and First REIT, get hit by currency headwinds. But we also saw Keppel REIT and ESR REIT show strong underlying performance and growth. Your job as an investor is to be a detective. When you see a number, ask why. Is it a temporary problem like forex or a deeper issue with the business? Understanding the difference is what separates a reactive investor from a strategic one. Today's market is rewarding those who look beyond the headlines. What do you think about these results? Is forex risk something you worry about in your portfolio? Drop a comment below. If you want deeper analysis and to know what I'm buying and selling, consider signing up for the premium newsletter. You get exclusive access to my portfolio and a front row seat to my investment strategy. Stay sharp and invest smart.